Good afternoon, everybody. I can see there's still folks streaming into the room. So before we get started, as I see folks still coming in, let me start by just reminding everyone we expect to have some time for Q&A at the end of what I think will be an informative presentation. If you have any questions, just press that Q&A button at the bottom of your screen, type in the question, and we'll get to as many as we can, time permitting. I'm Steve Ferrazzani, analyst at Sidoti. Thanks very much for joining us for the last session of Sidoti's Small Cap Conference. So pleased to be welcoming Kolibri Global Energy in the U.S. The ticker's KGEI. We're joined by CEO Wolf Regener and CFO Gary Johnson. Thanks, gentlemen, so much for being here. And with that, let me turn it over to you for the presentation.
Thank you, Steve. And thanks everyone for showing up here and being there, listening to us. Couple slides on forward-looking information, disclaimers, non-GAAP measures. On everything here, you'll see it's 22 and 23. Our financials come out next Tuesday. So you'll see the 24 numbers here next week. But to dive in, for those of you that don't know anything about Kolibri, we're an oil and gas company producing in Oklahoma. We operate the Tishomingo Shale oil field in Oklahoma. And overall, have low debt, have great cash flow growth that we'll show you here. We're fully funded for our 2025 program from existing cash flow and our existing line of credit. We have a $50 million line of credit with Bank of Oklahoma, and we have about 30 million drawn on that, no other debt. And we've just got a great asset, in our opinion, here in Oklahoma, 40 million barrels of oil equivalent in the proved reserve category, 53 million in the proved probable category. Our proved reserves just came out. We just did an update last week. We have about 78% of that in our proved undeveloped category, whereas 22% was in our proved developed producing category. And our proved reserves grew by 24%. That I mentioned, announced here last week. So with that, I'll get into the company on a whole. NASDAQ traded, KGEI on the TSX as well, and up in Canada, KEI is their tickers. And we have about 35.6 million shares outstanding. US market cap around 280 million. It's floating up and down a little bit. Only $30 million roughly in net debt. So it gives an enterprise value of just over 300 million. And our reserves value of what came out last week, the 40 million barrels of proved reserves, 535 million. So you can see that from where we're trading versus what the value is of just our proved reserves, we're quite undervalued basically. Our proved reserves and probable reserves together is almost 700 million US. With that, I'll give you a little bit of history of Kolibri. We originally drilled the Woodford Shale, where we drilled and participated in about 40 wells. We had about 12,500 acres. We've now grown that to about 17,000, by the way. And it was a very gassy. It was only about 15% oil, which you can see from the pie chart down there. The rest was natural gas and natural gas liquids. And Exxon had started buying out everyone around us and actually bought out everyone around us. We were the last holdout. They have about 280,000 acres in this trend. And so we ended up selling to them for $147 million, but we held on to the rights for an interval that was slightly shallower, about 300 feet shallower than the Woodford. And that's the Caney and the Upper Sycamore. And so that is a much oilier interval. Now our production mix here in the last third quarter was about 74% oil and the balance natural gas liquids. So we've really transformed from a natural gas producer into an oil producer and grew the acreage since we sold to them. For 2025, field development's continuing. We're forecasting production growth of between 38 and 40% over our 2024 guidance. As I mentioned, I'll stop saying the word guidance next week after our financials come out. We're going to be drilling 9 wells throughout the year, or completing 9 wells, I should say. And we'll have 4 wells that we're drilling right now, the 1.5 mile lateral Caney wells. In the past, we've drilled mainly 1 mile long laterals, and now we've extended that to drilling 1.5 miles, and our plan is also to drill some 2 mile laterals in the field. And that's what that reserve report now shows. So we'll be drilling and completing those wells in second quarter, 4 of those. And then we'll also be drilling a well on the east side, which doesn't have any reserves attributed to it yet. We have about 3,000 net acres out there, and I've got a slide that'll go into more details on that here in a few. And then third and fourth quarter, we'll be drilling another 2.5 mile lateral Caney wells, and then completing those 2 wells along with 2 previously drilled wells that are called the Violin that we've drilled in the past. So those will be coming on at about the same time. That all leads to our 2025 forecast, 4,500 to 5,100 BOE a day, which is an increase of 38 to 40% roughly. Revenue 75 to 89 million. So, is our forecast for the revenue. And then adjusted EBITDA 58 to 71 million. So call it a midpoint about 62 or so, or 65 or so, excuse me. And it just shows the growth that we've had from adjusted EBITDA over the last few years. So it's been a nice growth trajectory, and we're looking to continue that in 2025. Capital expenditure side of things, 48 to 53 million. So you can see difference between the adjusted EBITDA and the capital expenditures leaves us some cash left over. We've authorized the board has authorized a shareholder return policy where we started buying back shares in the company, and last reported we had about 280,000 shares that we purchased in order to return capital to shareholders. Moving on, production, you can see a nice steady growth that's been going on here. Fourth quarter production, you can dig it out of our reserve report, is about 4,400 a day in fourth quarter. So this chart needs to be updated. It'll be off the chart here on the top. So big step change for us from these last wells, showing the increase. Net operating income, the red line is our oil prices. And so you can see as oil went up, came back down again, but our growth has still been up. And then fourth quarter, obviously, with our production growth up, you'll see an increase here. All the infrastructure is in place for the field. So we don't have any large costs and large capital programs in order to where we have to increase the facilities in the field. And whenever we drill wells, we put in all the facilities, and that's included in our well costs that I'll talk about here in a little bit. Oil is priced at $1 at West Texas Intermediate pricing, less about $1.85. And then the new reserve report that we have, which are mainly 1.5 and 2 mile laterals, show 52 proved locations, 31 probable locations, and 21 possible locations. Total acreage 17,000, as I mentioned. Again, that doesn't include that those locations here do not include the 3,000 acres that we're trying to prove up with the Ferguson well. We have 36 wells on production right now, and as I mentioned, we'll have 9 that we're adding. The acreage is 99% held by production. So what that means is those deeper Woodford wells are holding those leases. And so we have the ability to drill where we want to. We don't have to drill where we're about to lose leases or anything else like that. So that really helps in our development. And on top of what we have booked and what Netherland Sewell has put together for us, we have additional upside from that east side acreage that I mentioned, and then also from 2 other intervals called the T-zone and the Upper Sycamore. So we'll see where those come into play in the long run. This is the estimated ultimate recovery that Netherland Sewell put together for us on a year-by-year basis as we're developing this field. The PUDs are proved undeveloped locations, so each location would produce, there is expected to produce about this much in a barrel of oil equivalent oil from each well. And the reason that I have this in here is just to show the reservoir quality of the field. Every year, as we had more and more history from the existing wells, they were increasing the amount of oil that they thought would be recovered from the proved undeveloped locations. After 2023, it stayed about the same. And now it'd be a different statistic because it's 1.5 mile lateral versus 1 mile lateral. So I just cut it off at 2022. Efficiency is big for us, and we try to focus on that a lot. And you can see from this diagram, this is depth, how long the wellbore is, so both vertically and then horizontally. And then how many days it's taken to drill those wells. And you can see all these squiggly lines where in the early days, we were out at around 30 days. So 2016, 17, we had about 30-day wells on average. Then in around 22 or so, 23, we had it down to about 20 days. In 24, and these are 1 mile laterals, by the way. So in 2024, we had it down to 12 days. So our well costs came down as well for these 1 mile laterals. So in 2023, our forecast was for a $7.2 million well. In 2024, the 1 mile laterals were drilled in $5.5 million each. So big drastic reduction. Now we started drilling 1.5 mile laterals. With the 1.5 mile laterals, it only took an extra 2 days. So we're getting 50% more reservoir that we're contacting with each wellbore, but it only took 2 extra drilling days. And that's resulted in more efficiency in that $5.5 million well cost for really good 1 mile lateral well. But 1.5 miles where we're adding that 50% additional, it's only 6.3 million. So that improves the economics of the field drastically. The east side, that Ferguson well that we're going to drill, all the infrastructure is in place out there as well. Gathering system is about a half mile away. We are the operator. We chose a section of the field where we have a 46% working interest, and a large integrated oil company has elected to participate along with their interest that they already had out there as well. So we kind of picked a section that we would have less than a 50% interest because it's a new area where there aren't any reserves so far. It looks really good to us. It has very similar characteristics and thicknesses as the heart of our field, except for that it's a little shallower. So the question in my mind is, we're going to make a well, but how good of a well are we going to make? What is the economics of it? Is it going to be economic at $50 oil? Is it going to be economic at $70 oil? Or is it going to be economic at $90 oil? So we'll have to try to figure out where that comes in. And that's the reason for drilling this, in order to try to prove the economics of this east side. And then if we do get that, I should say, we'll go back to be economic. It can lead to a lot more development locations for us. That'll hopefully increase our reserve report further. This is an enterprise value to proved reserve number comparison to other actually Canadian companies, because last year we did not do a reserve report in the SEC price scenario. So the SEC on the US side of things and the Canadian side of things use different prices. So in order to compare apples and apples, we've had to do that. So the average that they're trading for is about 45%. We're trading for about 33%. And I make the case that we should be trading for higher than the average even. And I'll show you why. One of the reasons is our operating netbacks. So how much we make per barrel of oil that we pull out of the ground. From the third quarter numbers here, we're about $40 per barrel of oil equivalent that that we produce and we make on the Canadian calculated side of things. So these are comparables to other Canadian operators that we feel are as close as possible to what we do as well. So we're more efficient. We get more per barrel of oil that we pull out of the ground. Overall, on a value basis, for 100% of our approved reserves, it's worth $15 a share per the reserve report for Netherland, Sewell. The proved probable is about $19 a share US. So lots of upside for us still from where we're trading. Our G&A has been coming down nicely. Operating expense per barrel of oil equivalent. So how much it costs for each barrel to come out of the ground. This is third quarter, we were at $6.63. And you can see that we're on the lower end of everything. The ones that are closest to us are actually natural gas producers, where it flows out of the ground naturally. So we're able to pull our oil out of the ground. Our operating expenses is very efficient for a low cost. Now, doing the same operating netback number for the SEC, how the SEC would calculate it, same thing. These are to US peers. So other operators that are good operators are very close to us. We're still slightly better on how much money we make per barrel we pull out of the ground on the US side of things, in US comparisons, I should say. Yearly net revenue has been increasing. The blue is because those are still forecast numbers. And I guess I mentioned next Tuesday, we'll be coming out with our actual numbers. So we'll be able to put a hard number in here and that'll turn green. a little history of management. I've got over 36 years of oil and gas experience in everything from land work to lots of operations experience to financings, um, natural gas, heavy oil, shale, etc. So that's my background on it. Gary Johnson, who has joined us, and he'll be here for the Q&A as well, um, has had over 30 years of accounting experience, including roles with Occidental Petroleum, where he was director of technical accounting. Dan Simpson has over 30 years of experience in petroleum engineering all around the world. Alan Hemme, over 12 years now plus of experience in oil and gas, and has been doing a great job for us as well. Um, Chairman for the board of directors here, Evan Templeton, is ex-Jefferies, among other companies as well, but there he was the senior credit analyst for oil and gas. So lots of oil and gas experience on the financing and credit side of things. Doug Urch, CFO of numerous companies in oil and gas over his career. David Newhouser runs Livermore Partners out of Chicago, is a large shareholder of ours, so brings lots of capital markets experience to us. And then Leslie O'Connor, who's retired now, petroleum engineer, ran MHA and Spruill's Denver offices for them, reservoir consulting firms, both, and so brings lots of experience as that as well. So what I'd like to say is we cover all the different we check all the different disciplines with our board as well. And that brings us kind of to the summary. I'm shooting for about 20 minutes, but ticker KGEI on NASDAQ, KEI on TSX. Great reserves that we have. We have a fantastic asset in our opinion. We try to keep things low debt. We've got lots of drilling locations to go. Our cash flow has been increasing. And our guidance hopefully is solid. I didn't mention it was $70 oil is what we're using. So fairly close to where we are now. It was higher than that when we put that in place. Doing shareholder return policy and looking to continue to grow the company, generate more money for the shareholders and return capital to the shareholders as well.
Fantastic, Wolf. Thanks so much for that presentation. Great overview of Kolibri. As a reminder, we do have about 10 minutes remaining. If you have any questions, press that Q&A button at the bottom of your screen, type in the questions, and we'll get to as many as we can, time permitting. I do want to talk about the positive stock reaction to the guidance you presented earlier this year, and certainly the production guidance was very healthy. Does that in any way make you rethink the strategy? Hey, people really like the production growth.
No, it has to be a balance for us, right? We don't
Okay.
want to over leverage ourselves. So we don't want to take on a bunch of debt. And we
Yeah.
want to return some capital to shareholders. We have some larger shareholders as well that have been in stock quite a while, who have all kind of indicated they'd like to see some return of capital, as well as some other shareholders. So we're keeping that in mind when we do things, and when the board decides. That's part of our discussion always is how much, excuse me, do we put in the ground versus how much do we
Yeah.
return to shareholders? And we're just literally the company just got to the stage where we have a lot of cash flow that's starting to come up for our
Yeah.
size, that we have the ability to do that.
Talk about the patterns in terms of converting PUDs into PDPs.
Yeah, so the big change from the reserve report this year was we were drilling these 1 mile laterals, right? And
Yeah.
so now we're drilling 1.5 mile laterals. So a lot of our proved or a lot of our probable reserves moved into the proved category.
Yeah.
Now, Netherland Sewell does what they want to do with it. I would not have moved our decline curves quite as low as they would have. So
Okay.
we had about a 1% drop in our proved probable. And that's just because they're being conservative as we drill these longer laterals if they're as efficient
Yeah.
as 1 mile laterals. So I'm hoping this year as we drill wells, we'll show that they really do perform that way. That these 3 that we drilled continue to perform as we expect
Yeah.
them to. Then hopefully that number will go up as well.
What went into the strategy, which now, at least thus far, looks extremely successful, the switching to the 1.5 mile laterals? What got you to that change? And obviously, given the initial production and the costs that you've shown, which outperformed both ways. What got you to that successful plan?
We have a field that is a little unique and it has a pretty steep dip when we're drilling. So
Okay.
we had to, when we drill down, we kind of either drill up or we drill from here and drill down. And so when you're doing that, you want to make sure that we have really good control over where we're placing our laterals just
Yep.
from the start to the end of it. And until we were comfortable that we were really having an easy time controlling even the end of the mile lateral, that we felt comfortable going with a mile and a half. So we changed
Okay.
technologies until we got to that stage. And that's really, once we were there, then we said, yeah, we feel comfortable with going to a mile and a half lateral instead of, doing it too early and then having fumble our way through it or having a well that costs too much. So it's all, we try to be very methodical in how we develop things. We try to use as much science as possible. And we really try to walk before we run and really
Gotcha.
understand the reservoir in a field. So we're not wasting money. The last thing I want to do is burn money.
Of course. Uh, Next plan is to drill the 4 wells on the one pad.
Mhm.
Theoretically, the economics on that should be better in terms of costs and timing. You indicated in the release that your expectation is production in June. Would this be a part of the plan moving forward, or does the acreage allow you to do the four wells
Yeah,
on a
it'll
pad or
depend.
more? Go ahead.
Yeah, it'll depend on where we are in the field. So it'll
Yep.
be, but generally we're looking to drill multiple wells from the same pad in order for the efficiencies to keep them up as high as possible. Right. We originally
Yeah.
developed the field by trying to figure out where it is. So we moved out mile by mile, section by
Yep.
section. And now we're coming in to just infill that and drilling, anywhere from, I'll say 3 to 5 in general from a single pad in order to
Okay.
develop the field.
Okay. Can you talk about the timing now of drilling on the eastern acreage, which you hadn't done before? Any reason for the timing now? Is there a reason to think that's not as good because you hadn't drilled it before, or is there any read through on the timing of this?
No, I mean the timing is just cash flow, right?
Oh,
So we
yep,
kind of stepped out about develop the field. Then in 2022, when we started drilling, we said, okay, we kind of defined the first phase of it, so to speak.
yep,
We didn't touch that because there's a little structural difference on that side. And so we went ahead and said, now it's time for developing cash flow. So we get the cash flow up. Once the
yep.
cash flow is up, then it's okay to take another step out to
Got it.
put one well out there. And that's why, you split it too. As much as we like that acreage, it
Yep,
looks really good. It's a little shallower. So how big of an impact is that going to have on your economics? And that's really what it
sure.
comes down to.
And it's important to note that portion is not in your reserves report at all, so it's pure upside to
Correct.
reserves. Okay.
Correct.
Okay. Um, we are not surprising. We are given recent trends with oil prices and just general global economic uncertainty. We are getting questions around your hedging strategy and does it
Mhm.
change at all now?
No, not really. I mean, we try to use costless colors, and I'll let Gary actually answer that. So he hasn't said anything here yet.
Yeah, so we've hedged about 50% of our production. We have a pretty wide band on the costless collars, so we're like average is about to be 60 to 90. So as long as we're in that
Yep.
area, we're just kind of protecting the floor. So we have some variability there, but we do have like I said, 50% hedged right now.
No,
And
that way we
how
don't get
far
limited on the
forward
upside.
how far forward do you try to go?
So we're actually required the bank to hedge a certain amount. So we're hedged about for next year at 50%. I think the two
Okay.
quarters after that into 26, so about 35% right now.
Oh, so you are already hedging into 26.
Yeah, a
Yeah,
little bit.
Okay.
for half the year. Mhm.
Got it. Okay. And that you mentioned the T zone and then Upper Sycamore. Those
Mhm.
are also areas you haven't touched yet.
So we drilled a couple T-zone wells. We
Okay.
did that in 20. We had one old one that we drilled very early on with an old fracture simulation technique. And then we did a few last year, or in 2023, excuse me. We're in 2025 now. And we found that the T-zone is right below the caney. And we found out
Okay.
that it is stimulating up into the caney and it actually interfered with one of the pads that we did.
Okay.
and it interfered with the production from just pushed too much water up into the Caney. So it was instead of doing 6 wells per section spacing, it was the equivalent of like doing 12 in that one section. And
Got it.
so what we decided was we're just going to focus on the Caney right now. When the Caney has been more depleted in an area, then we can come in and drill the T-zone wells. And if in those areas where it accidentally fracks up into the Caney, it's not going to interfere with anything. So we have that basically in our pocket for the future reference or
Got it.
for future access.
Got it. We touched a little bit on capital allocation. You did buy back some shares. What's
Mhm.
the strategy moving forward? I mean, I know generally you try to keep your drilling program within expectations of cash flow from operations. Is the excess for the buyback, or are you going to try to spread that a little bit more, give yourself a little bit
Yeah,
more
so
room, or
yeah, it'll be a little patchy, right? So when we're spending
yeah,
a lot of money in the field and we're having to draw down the line, then we'll do a little less in the as far as buybacks go. And then when we're,
yep,
when we're back on the paid for that, then we can increase the share buybacks too. So it'll be a little lumpy. It won't be quite as even as everyone might like to see, but really
fair
that's
enough.
kind of the plan.
Got it. I did have a question about how much you pay attention to what other operators in the area are doing, and just do you try to generate any strategy, or are you?
Absolutely. We do always. That's the nature of this business.
Yeah,
You never know when someone else is going to have a great idea or
fair
something
enough.
that really works well. And so without a doubt, and we are looking to grow the company, not just from this itself, but also looking to see if there's anything accretive that we can get into that makes sense for our shareholders in order to add more value.
Got it. You've mentioned in passing the potential to eventually do 2 mile laterals. Where is that on the radar screen?
It just depends on the area. So some
Okay.
parts of the field are just better suited to a 1.5 mile lateral on development wise, just because of a fault, let's say, or how some of the early wells were put in, just
Okay.
where we see the structure at. And some parts of the field are just work better for 2 mile laterals. So it's not that we're staying away from 2 mile laterals by any
Right.
means. I don't think it's going to be a huge amount of difference between the 1.5 mile and 2 mile laterals from a risk point of view for us.
Got it. We are just about running out of time, but I do want to give you a chance. Well, if there's anything we didn't cover, what do you think? I mean, I think over the last 6 months, people seem to be learning the story more. The stock certainly has performed. Anything you
Yep.
think people are still missing? Anything you want to educate them about around Kolibri?
No, I think we don't have a whole lot of research coverage, right? So it's just for us getting out there, getting the word out there. We try to be conservative in everything. Like I
Yep.
said, I've been 36 years in this business.
Yep.
I've seen my ups and downs, and so we try to really run the company for the long term. We try not to, do something that's going to spike the stock for 3 weeks and then have it come back down again.
Yeah.
So we're trying to run a good company with good growth and just do things the right way, and then the stock price should follow.
Fantastic. CEO Wolf Regener and CFO Gary Johnson from Kolibri Global Energy. Thanks so much for joining us today, and I hope people found it as informative half hour as I did. Thanks, guys.